Did you know that the average stock market return over the last 90 years is about 9% per year? Yet, most investors fail to beat this number. How? Simple. They don't follow the proven principles of value investing. Value investing is more than just a buzzword. It's a strategy that's been used by some of the world's wealthiest people. Think Warren Buffett, who turned $100 into over $90 billion. Or Benjamin Graham, the father of value investing, who taught Buffett how to find hidden gems in the stock market. It's not about jumping on the latest trend or gambling on risky stocks. It's about finding companies that are undervalued, making smart moves, and holding for the long term. In this video, we'll break down the most important concepts of value investing. You'll learn how to spot undervalued stocks, why patience is your best friend, and how to make money, even when the market's down. Ready to unlock the secrets that most investors miss? Let's dive in. Chapter 1. The magic behind margin of safety. When it comes to value investing, one of the first strategies you'll learn is how to find undervalued stocks. It's all about spotting hidden gems in the market, companies whose stock prices are lower than their true worth. But how do you find them? The secret lies in fundamental analysis. Fundamental analysis involves studying a company's financials, management, competitive position, and growth potential. One key indicator value investors use is the price-to-book ratio, P/B ratio. A P/B ratio under 1 often signals that a stock is undervalued. Companies with low P/B ratios are often ignored by the market, even though they have strong assets. Warren Buffett famously said, "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price." The strategy here is to find companies with solid fundamentals but temporarily overlooked by the market. Next, you need to dig into the earnings report. A company with consistent revenue and earnings growth but a lagging stock price is a prime candidate. In fact, the average return of undervalued stocks outperforms the broader market over the long term. According to a 2022 study by the CFA Institute, stocks bought at a discount based on their earnings multiples yielded a 12% annual return over the past 50 years. But finding these stocks isn't about picking random companies. It requires patience and a solid understanding of what makes a good investment. Buffett's strategy of buying undervalued stocks based on their intrinsic value has led to massive returns. He often uses discounted cash flow, DCF, analysis to determine whether a stock is undervalued. DCF is an estimate of a company's future cash flows, discounted back to present value. When doing this, always consider the company's economic moat, a competitive advantage that protects it from competitors. Moats can be hard to quantify, but looking at factors like customer loyalty, cost advantages, and barriers to entry helps a lot. Once you find these undervalued stocks, the trick is being patient. Remember, as Buffett says, the stock market is a device for transferring money from the impatient to the patient. Chapter 2. The hidden power of intrinsic value. Next up, let's talk about intrinsic value. This is a crucial concept for value investors, as it helps determine whether a stock is truly worth the price you're paying for it. Intrinsic value is the real worth of a company based on fundamentals, things like assets, earnings, and growth potential, rather than its market price. In other words, intrinsic value tells you what a company is actually worth, compared to what the market thinks it's worth. To calculate intrinsic value, value investors use methods like discounted cash flow, DCF, analysis, which helps estimate future cash flows and bring them back to their current value. Think of it as figuring out the future earnings of a business and asking, is this business undervalued at this price? In the real world, finding intrinsic value isn't as hard as it sounds. Buffett himself once said, "Price is what you pay, value is what you get." If you can identify businesses with strong earnings potential, a durable competitive advantage, and consistent growth, you're on the right path. Take Apple, for example. Many investors saw Apple's market price soar, but the company's intrinsic value was already clear years ago. When you're able to separate emotion from investing and focus on a company's fundamentals, you can uncover opportunities that others might miss. Remember, the goal isn't to buy stocks because everyone else is. It's about buying when the stock is trading below its intrinsic value. Chapter 3. P/E ratios. Beyond the numbers, let's dive into one of the most popular valuation tools, the price-to-earnings, P/E ratio. This ratio helps you determine how expensive or cheap a stock is compared to its earnings. Simply put, the P/E ratio is calculated by dividing the stock price by its earnings per share, EPS. But here's the catch. The P/E ratio alone doesn't tell the full story. What most people overlook is that P/E ratios vary by industry. A high P/E ratio could be a sign of a high-growth company, while a low P/E ratio could mean that a company is undervalued, or it could also signal poor performance. For value investors, the goal is to find stocks with a low P/E ratio relative to their growth potential. For example, if a company has a P/E of 8 while its competitors in the same industry have an average P/E of 15, this could signal an undervalued stock. But, as always, you need to dig deeper. Look at the company's growth rate, market share, and economic moat before jumping to conclusions. While P/E ratios are a useful tool, they aren't a magic bullet. A great stock price might still be overvalued if the company doesn't have strong future prospects. It's always best to combine the P/E ratio with other metrics like the price-to-book, P/B ratio, and price-to-sales, P/S ratio to get a more complete picture. Want more tips on finding value? Don't forget to subscribe for more in-depth discussions on stock evaluation. Chapter 4. The Sleepy Giant, the Power of Compound Growth. Next, let's discuss compound growth, one of the most powerful forces in investing. Compound growth is the process where the returns you earn on your investments start earning their own returns. It's like planting a tree and watching it grow taller and stronger year after year, as new branches sprout from the original trunk. One of the most famous investors to use compound growth was Warren Buffett. In fact, his wealth grew exponentially because he kept reinvesting his earnings. When you give your investments time to grow, you tap into the magic of compounding. In simple terms, the more time you give your money to grow, the larger your returns will be. A study by Morningstar found that an investment of $10,000 in the stock market in 1965 would be worth about $1.1 million today, thanks to compound growth. The key is to stay invested, reinvest your dividends, and let time do the heavy lifting. The key takeaway? Patience pays off. If you invest in solid, undervalued companies, and hold them for the long term, compound growth will work its magic. Now, with that in mind, make sure to subscribe for more strategies on how to harness the power of compounding. Chapter 5. The value of a dollar today versus tomorrow. Have you ever wondered why time value of money is so important in value investing? The basic idea is simple. A dollar today is worth more than a dollar tomorrow. Why? Because you can invest that dollar today and earn interest or returns, making it worth more in the future. To make smart investment choices, value investors must consider how money grows over time. This involves discounting future cash flows to their present value. The discounted cash flow (DCF) analysis comes into play here, helping to compare the present value of a company's earnings to what the market is willing to pay for them. For example, if a company is expected to generate $1 million in earnings next year, but you can buy its stock for only $800,000 today, that's a great deal. It shows that the market is undervaluing the company's future earnings potential. Understanding the time value of money allows investors to make better choices by weighing present value against future potential. Remember, the earlier you invest, the more time you have to benefit from compound growth. Chapter 6. Moats. Building fortresses around profits. Let's wrap things up with an essential concept: economic moats. A moat is a competitive advantage that protects a company from competitors, much like a castle surrounded by a moat to keep invaders out. Companies with strong moats are better equipped to withstand market disruptions and continue making profits. Buffett loves companies with wide economic moats because they're built to last. Companies like Coca-Cola, Apple, and Google have huge moats. Their strong brands, patents, customer loyalty, and cost advantages keep competitors at bay. A company with a narrow moat might struggle to maintain its competitive edge, but one with a wide moat can continue to thrive, even in tough markets. So, when you're evaluating a stock, always ask, does this company have a durable competitive advantage? If the answer is yes, you might be looking at a great long-term investment. That's all for today's lesson on value investing. Keep these principles in mind, and you'll be well on your way to making smarter investment decisions. Remember, it's all about finding undervalued stocks, understanding their intrinsic value, and holding them for the long term. Be patient, and the results will come. Don't forget to subscribe for more tips on mastering the world of value investing.